Welcome to the Economic Preparation Channel. This is Tony speaking for Sunday, October 19th, 2025. But just briefly, we're going to talk about the tariffs and the budget deficits, as well as the widening gap between the super rich and the super poor in America. As we continue to follow these stories here, please be sure to subscribe and hit the like button. Thank you for your support. We're continuing to get into this. CNBC reported this past week, Thursday, that tariff costs to companies this year is going to hit $1.2 trillion, with consumers taking most of the hits, as S&P says. So obviously, the tariffs are raising money for the government, but they're going to be passing those costs on to everyone through the grocery store, through everything that consumers buy, through appliances, electronics. And so just the firm says just 1/3 will be borne by the companies, with the rest falling on the shoulders of consumers. And that, coupled with layoffs in some of these industries, is going to mean a total recession disaster for next year, coming up next year. So while Americans may face a transition period from tariffs upending a broken status quo that has put America last, the cost of tariffs, quote, will ultimately be borne by foreign exporters, White House spokesman Kush Desai said in a statement. But as you can see, every week that we go to the grocery store or go to the place, everything is rising significantly. And these costs have not come down lately, and gas prices have not come down lately either. So we're looking at these tariffs being implemented, and like I said, it's going to take a couple months. We're going to see the full brunt of these tariffs starting next year, January, February, and that's when we're going to start seeing these tariffs work their way through this economy here, this $20 trillion American economy. So the U.S. budget deficit edged lower in 2025. Tariffs, debt payments both saw new records. So as you see here, they're collecting this money here, and they're lowering, supposedly, quote unquote, lowering the budget deficit a little bit here, okay? But the problem is we're still $38 trillion in debt. And on top of that, we have a slowing labor job market, and we have housing crisis, with less houses being available, and the houses that are available are expensive, and rents are out of control too in the majority of the top 20 of Americans' cities. So that's what we have going on here. And so we have to look at that. The interest on the debt totaled more than $1.2 trillion, also a record, and nearly $100 billion higher than the 2024 outlay. And with the government shut down right now, things are going to be very interesting, because some people are saying that we're in an AI market bubble. But remember, in Venezuela and Greece and Lebanon, those countries that the currency crisis had a currency sovereign debt crisis, all of their stock markets melted up, okay? Venezuela's stock market melted up. And as long as commodities melted up, everything melted up. Bitcoin, silver and gold, stocks, cryptos, T-bills, everything melted up. And so it's possible we could be heading to a melt up before the meltdown in this U.S. economy to make it look good. Now, absolutely a market bubble. Wall Street sounds the alarm on AI-driven boom as investors go all in on this AI stuff. So this reminds me a lot of the dot-com bubble in the early 2000s, late 90s. Remember that? Everybody was buying up all the domain names, buying up all this stuff. This is the exact same case here. But with AI, it does actually provide you with physical, tangible robots and physical, tangible Chat GPT and Gemini and all these different things. It provides you with physical, tangible, quote, information, which is currency. Data is currency in this new technocratic, autocratic society that we're in. You know, people are selling your data. They're selling all your information. No matter what privacy protections you have on, it's being sold, data brokers, all that stuff. So AI does have that utility going for it. But after months of record gains in AI-linked stocks is on paper. If you don't hold it, you don't own it. Concerns are mounting that the boom is starting to look like a, quote, bubble. And so next year, if we get one of these bubbles pop, either the AI or the housing bubble, when asset prices are this elevated, you have further to fall. And that's what Jamie Dimon said. He said, quote, consumers are still spending and companies are making money. Valuations and credit spreads remain stretched. In other words, these valuations, just like home price valuations, are 2 to 3 times over what it should be, what it's actually worth, you know. So you have a lot of assets out there that look like they're entering bubble territory. This is what Jamie Dimon said. I didn't say that. So Jamie Dimon says, quote, that doesn't mean that you don't have 20% to go. It's just one of those more cause for concern. As you can see, the Dow Jones is at 46,000. Many people believe that it shouldn't even be half that. It should be less than 20,000, considering the earnings reports and different things like that. Remember, they're cooking the books. They're not cooking the books on jobs. They're cooking the books on, the number of people. Everything is being cooked in the books. The number of people that's looking for work, the number of people that's out of work, the earnings reports, you know. And so the AI equity bubble, according to Bank of America's latest global fund manager survey that was released Tuesday, said that an AI equity bubble is one of the top global tail risks for the first time in history. And the survey supposedly, allegedly profiled 200 fund managers overseeing nearly $500 billion in assets. And it just says that, look, we're in this bubble. We've had this before. So history does repeat itself. So be careful out there. AI is good, but remember that if you get too FOMO in this, if you get this FOMO, fear of missing out, it gets in a bubble, it pops, then, there goes some of your money. So Americans' wealthiest shoppers are boasting spending, according to Yahoo Finance, in the U.S. economy, while lower earners are pulling back. Well, lower earners, middle class, and lower earners, we've been pulling back since, before 2020, before the C-19 thing happened, before all of that, because, many people saw this coming, that what goes up must come down. The stock market has been on a tear, going up the last 14 years, and now we've reached the point where they've squeezed the maximum amount of dollars out of this turn-up thing here, just about, and we're at the top of the roller coaster, and we're about to go down very shortly. So, but it's not going to affect, like he says, not going to affect America's top 1% earners. Those people making over $1 million, or making over $5 million, or whatever it is, the number that they come up with, most of these surveys come up with. So, Americans making over $100,000 a year are boosting the economy. Injuries rates from travel and the auto industry to packaged foods. At least is what they're telling us here in the media. So they're saying that, the rich people have money to spend. They're going to continue to spend it regardless of when a depression, recession, or whatever. They're going to continue to travel, go to these exotic places. They're going to continue to spend money in this economy. But many people are pulling back. They're living together. Multi-generational families. I'm seeing in a lot of these neighborhoods, 6-7 cars in the driveway. I'm seeing more older cars, and less leased cars in the driveway. I'm seeing families pull together. I'm seeing less spending. I'm seeing less eating out. A lot of these restaurants are closing down. Let me know what you're seeing in your suburb, in your town, or your city and township. A lot of these restaurants are closing down, or merging, that we used to have back in the day, and that's a sign of contraction in this economy. And the only thing that they're building new in a lot of these communities here is the car washes, a few gas stations, storage unit places like that, Harbor Freight places like that. They're building new places like that, and Dollar General or Dollar Tree. Those are the only type of places that we're building here in America. And maybe you occasionally will see a new fast food joint come up, like a Popeyes, or some other little thing come up on the corner. But Walgreens, CVS, they're scaling back. You see they're closing down a lot of that too as well. So I'll tell you to continue to prepare, because this money is not going away. The debt is not going away. The job market is getting very, very soft. And by the time they tell you that I have a 10% unemployment rate, it'll be too late. Most of the jobs will be out. Continue to create, continue to build for yourself. Try to be as self-sufficient as you can. I know it's hard to get off the grid, obviously, because, the water's controlled, the electricity, everything's controlled. But it is possible to at least, start growing your own food somewhat, and having, some type of a homestead mindset. Even if you're in the suburbs, the city, or in hinterland, you can have somewhat of independence to be able to sustain what's coming up in the future. So God bless. Take care. I'll see you very soon. Thanks for listening to me. Talk to you soon.